BlackRock, DTCC, Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
You said it. You finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're on 4th floor today. We're gonna be on floor 1, and then we're headed straight to the moon, boys.
Yo, happy Monday.
A lot of green out there today.
Yeah, the ticker looks pretty green, doesn't it?
Ticker looks pretty green. While we're on the ticker, sponsored by Call Sheet, the prediction markets here. We've got some new prediction markets, and if you realize we don't have Wimbledon 2025 scrolling across the screen anymore. We've got will the Federal Reserve hike rates in the January 26th meeting? Will Trump create a national Bitcoin reserve in 2026? Will Trump buy Greenland, currently at, what is that, 36%? Will Trump nominate Rick Ryder as the next Fed chair at 48%? That's a BlackRock guy. I think that's bullish for Bitcoin. So yeah, we revitalized the Call Sheet ticker. We got a lot of green out there on the Coin Gecko ticker. We had some advertisers leave the bottom thirds. We had some advertisers join the bottom thirds. So yeah, it's a lot of fun. It's a lot of fun here on the Rollup. How was your weekend, buddy?
It's good, man. Excited to be back Monday morning here in Hawaii. Gold is at $5,035 per ounce. Silver is at 108, and nobody wants to buy the coins. S stocks looking ready to go to new all-time highs, and nobody wants to buy the coins.
Why would you want to buy the coins? The last couple of days, we've had a recurring point on the show with several of our guests, which has been the lack of quality assets in the space. And so part of the neo-finance thesis here is that the tokenization of stocks and private credit and metals, which is now the tokenized gold market, is now a $4 billion market, thanks to both the further tokenization as well as the price appreciation of gold. These are assets that will come on chain. And so we won't be forced to buy shit coins. We'll be
maybe that's not the best thing though.
Several different tokenized options and quality assets.
Maybe tokenized gold is the problem for Bitcoin. Maybe. It could be. It very well could be.
Look, man, my my asteroid mining thesis is in full swing.
No, but you're just a no coiner on the gold side, so it sucks, man. Sorry about that.
I'm a no coiner.
Sorry for your loss.
Sorry
for your loss there.
I do think gold has a lot of room to run, but I get in trouble when I start to chase. You know, like
FOMO
those who got it. What's that?
FOMO is the mind killer on gold. I mean, you don't want to buy that thing right now.
I run into trouble when I chase. I think I bought Zcash at the Pico top.
Nice.
I'm underwater on Zcash. That thing was a runner.
Oh, get me out of there. I'd be so out of there so quick. Oh, hit me out of there.
Zcash to gold is probably a good move here. Let's see what we've got in our headlines here. We'll run through.
Yeah,
Bring it up.
Cards, tokenized RWAs, gold, Ethereum, all this stuff. So let's go. Neo Finance is on the tip of the tongue, is on the tip of the conversation once again here on Rollup TV, guys. If you're watching on YouTube, the 7 of you so far, hit like, hit subscribe, say what's up in the chat. We'll be there. We'll be hanging out. Yeah. Stablecoin cards are going semi-atomic. Yo, we here. What's up, man? So Cards for the Win is a really cool, basically newsletter about stablecoins. They want us to subscribe. I don't think we're going to subscribe right now, but basically a stablecoin card primer. Stablecoins are going semi-atomic, and it just keeps happening. Gold before 5K, gold 5K before ETH was crazy. Yeah, I feel like that was kind of obvious at a given point, though.
I mean, I think it's important to, or obviously we've got stablecoin cards up here. We'll talk about gold a little bit later in the show, I guess. But I think it's interesting to explore why gold is appreciating so much. But first, stablecoin cards.
The Fanatics guys really want us to sign up. Maybe we should tell them that their UX of forcing us to subscribe instead of just getting to read the free content isn't really helpful to our show. So primer Fanatics boys, we're just going to skip you guys and skip your free marketing because well, yeah, we're not going to sign up for your newsletter, but mahalo, much love. Fanatics is launching a fan cash rewards card. And yeah, I mean, this is just going to keep happening. Let's move on though. Sorry guys, in your fan cash newsletter, your paid newsletter, like who pays for newsletters anymore?
All right,
much love though.
What we got next? I mean, generally we've got, yeah, let's keep going here.
Yeah, sorry, Fanatics. Once again, it's not going to work here, guys. Tokenized RWAs hit $22.5 billion all-time high. Treasuries, of course, being $9.7 billion. Commodities, gold, barely existed 18 months ago. TradFi is racing to catch up. We don't call it TradFi anymore. We call it legacy finance. Yeah, I mean, look, if you look at the actual chart, it's pretty insane. There is just immense growth here in the RWA space. And yeah, it's pretty bullish. You love to see it.
Earlier, you were saying that maybe this isn't so bullish. I think, you know, there's something to say here about, like, there's the assets and then there's the protocols. And the idea is that obviously if we ramp up activity and all money's on chain and all finance is happening on chain and transactions go way, way up, then in theory, a lot of the blockchains are going to be collecting a lot more fees. You're going to have rent seeking happen at the wallet level. You'll have thriving businesses as infrastructure, you know, for this tokenized financial system.
Yep.
You know, at the same time, a lot of that activity is a result of not the tokens themselves, but it's a result of the quality assets that are coming on chain.
Yeah.
Like gold, like RWAs, private credit, all these things.
I just mean that, like, tokenized gold on chain maybe is bearish because you could just buy that instead of buying Bitcoin.
So I think if we're getting into the gold thing now, the reason my understanding of why gold is appreciating so much is kind of stemming from a lot of what we heard at Davos, not as a base layer, but that was sort of when it got brought into the public. You had this Canadian guy, forget his name, but the new prime minister over there is saying that there is this rupture of the global monetary order. And we can see that it's not just rhetoric, like political rhetoric, you know, because Trump is, you know, talking about Canada as a 51st state. There's actual data that is showing how central banks are decreasing their US dollar reserves and increasing their gold reserves.
Oh, yeah.
So, yeah, go ahead.
No, Tether bought $4 billion worth in Q4 last year.
Tether's not a central bank, but yes, they did buy a lot of gold. And China, there was a chart that I think it was Infinity Hedge or Zero Hedge, one of these guys posted how the central banks used to have, I think 60% of their reserves, and it has slid significantly in the last like 3 to 5 years. So this is a macro trend where the US is nationalizing a lot more of its economy, right? It's bringing manufacturing, it's bringing all these things. And we talked about this around the time of the election and the inauguration, like the globalists lost, right? And I think one of the benefactors of the globalist regime was the US dollar as this global reserve currency. Now we're realizing that, America doesn't want to be dependent on some of these other nations for manufacturing. And so we're taking a lot of that home, and vice versa. What's the counter? Like, we were importing all these goods and we were exporting dollars, right? And if we're now not relying on these external countries for their goods and their manufacturing, they're not going to be reliant on us for their currency, right? So now this trade imbalance is starting to shift, and they're saying, okay, well, America's doing their thing. We're going to also take sovereignty in our own hands. We're not going to be reliant on the US for economic policy and for these reserve currency. We're going to kind of go back to a more sovereign store of value for our central bank. In gold. And then
I get that.
We're seeing retail sort of pile on top.
Yeah, I mean, look, I just wish that I had actually deeply read that Rise of America book more closely in 2020, because I would have been buying, at least even if I just put like 10 grand into uranium, it's like a 7x from there, 8x from there. Copper, the same thing. Now all these things are happening, and it's like, I'm just glad that I got in on gold and silver, and then obviously Bitcoin and crypto. And then now I did get a pretty good entry on uranium. I'm already up to like 25% on or something, maybe 15%. Just picked up some copper as well. I feel super late to the copper trade again. I was like, that was a 2020. So it's just crazy. Everything that he talks about, the rare earths, the precious metals, the energy, all of it is just like coming to fruition. Crypto as well.
But this is a very slow game. This is something that
that's why it's no rush.
Plays out over a decade.
But like the entry is where the gains are made.
Yes, absolutely.
Investing is what I've learned. Like, the entry really matters, and like, I mean, there's still a lot to be had on the copper and uranium trades, I think, but not exactly sure where it goes. So look, there's the chart for the RWA value. It's absolutely up and to the right. It's the best chart in the entire space. Let's move on to gold. We have something upcoming next. We've got our gold hits a new all-time high over at 5,100 per ounce. Pretty insane run there for gold.
So the question now, like, if the premise is that there is a reshaping of the global monetary order, central banks are dumping the dollar and they're investing in gold, the idea here is like, will we see a catch-up trade? And
I hope so.
Yeah.
But maybe not. Maybe it's just absolutely, I don't know. But I came on here to talk neo finance.
Tokenized gold.
If you look at the weekly chart, it looks really bad. So we have a week to save the Bitcoin monthly, or else, boys and girls, GG's.
I just don't think it's that. I just don't think it's that bad. I think
I mean, look, dude, we are going to get all the rate cuts in the world. We have the best setup ever. Like,
they're talking about
ripping.
They're talking about intervening in the Japanese currency market. What does intervening mean? The definition of intervening is print money. So this debasement trade that is leading to gold going exorbitantly high. There's a lot of overlap. It's not 100% overlap.
There's a lot of overlap for sure.
But there's a lot. The overlap is in the debasement. The part that is not overlapping with Bitcoin and could maybe lead to like not as much. I think there is some catch up to be had.
Yeah.
But maybe it's the reason it's not going to like go back to the same Bitcoin gold or ETH gold ratio is because of the accumulation you're having. Like, I don't think central banks, El Salvador is still an enigma. Like, I don't think like the central banks are going to be getting Bitcoin. Like, they're talking digital asset stockpiles. They're talking national Bitcoin reserves. El Salvador is one of the only ones still to have done that.
Yep.
The central banks are going into gold. And so maybe this is a stepping stone for something that plays out over decades.
No, for sure it is. It's for sure Bitcoin is the next logical step.
But we thought Bitcoin was a logical step after the US dollar fell from the global currency status.
Yeah, because you're a zoomer. It's because you have we have no actual real world experience in investing, and we think our little coins are the savior for everything. It's like, no. The big boys play a different game. When they want to store value, that's why they're buying gold.
I think it did still catch a lot of people off guard that they reverted to the thing that was the predominant reserve currency back in 1971, rather than kind of moving in a chronological sequence.
Nah, I don't think it caught anybody off guard who actually has manages size. Maybe it caught like the crypto whales off guard who are managing 9 figs, 10 figs, but anybody who's managing like high 10 figs, 11 figs, this makes sense.
Well, then I think we ought to be looking at some of
But
the same
the narrative's going to
indicators.
happen when it comes, right? Like if Bitcoin pumps, it's going to be the same freaking narrative. It just hasn't. As soon as Bitcoin starts to move, it'll be like, oh, of course, the debasement trade is on.
The debasement trade, yes,
Digital
but
gold is coming next, but like
the
until that
whole
happens,
central banks leaving the US dollar as a reserve currency is
Well-
not going to be the same narrative as to
okay,
why
well then
Bitcoin goes up.
let's get to what's next, because this is what's causing a problem here with Bitcoin's narrative is this quantum stuff. People are really confused about the quantum side of things. They don't quite understand how Bitcoin's going to solve for this. Let's move to this because Ethereum seemingly is going into a more post-quantum direction from this 1 million impression post by Justin Drake. And so today marks an inflection in the Ethereum Foundation's long-term quantum strategy. We formed a new post-quantum team. After years of R&D, EF management has officially declared post-quantum security a top strategic priority. You got to think, is this a response to the negativity in the Bitcoin meme, in the Bitcoin quantum space, or is this a proactive response? Our journey began in 2019 with the ETH 3.0 quantum security presentation. And look, it's been central. Look, guys, so Bitcoin has this narrative right now amongst all the big asset managers that it's going to have this massive quantum issue in the future. It has this narrative that Bitcoin is going to be, the algorithm is going to be taken down by quantum computing and it's not investable long-term. And so I think there's a real narrative overhang happening here. And so Ethereum is trying to come out and basically be like, look, we're going to be post-quantum secure. We're a proof of stake network. We're not reliant on SHA-256 algorithms like Bitcoin is in terms of proof of work. And look, we're going to do it and we're going to make sure that we are post-quantum. Then you got guys like Vance talking about how ETH's going to flip Bitcoin because of this. You've got ETH maxis being excited about this. And then you've got the Bitcoin core devs saying, we're fine. Nothing's going to happen here. We're good. We're all good. So you've kind of got this weird classic dynamic between Bitcoin and Ethereum communities where quantum is this narrative overhang on Bitcoin. And I'm not sure that asset allocators of size really want to get into Bitcoin with this narrative overhang because I don't think they really even understand it well enough to.
So, couple weeks ago, we did have on Project 11, which raised, I believe it was something like $20.5 million to solve this problem. And we discussed how immediate this is. And, you know, it's a slippery slope because you don't know exactly as far as predicting when this happens. But the conclusion that is being drawn is that it's not a 0 to 1. It's not a flip switches and everything changes. It's, you know, it's incremental in the sense that we will see it coming. And I think this is true also of AI and a lot of like really, really impactful technology shifts. And so when it comes to, you know, Bitcoin and protecting against quantum, there are teams that are raising a lot of money and going out and they're doing this. And I think, you know, if you look at where the pinnacle of quantum research is today, you have to say there's good guys and there's bad guys. And just because someone has a quantum computer doesn't mean that the first thing that they're going to go do with it is hack Bitcoin. There's a lot of things out there that could benefit from quantum. And once we have something close, we know that we're going to get pushback from the quantum secure community. And so it's really a fight against good and evil. And there's a lot of money and resources being fed and poured into the good people fighting this fight. We also know now that this is no longer a scientific discovery question where it's, you know, trial and error and we're testing things and like pouring things in beaker bottles. No, this is more of an engineering problem. And so as we throw more resources at this, we will get closer and closer. There's two sides to that. The good side is that we will see it coming because we're going to continue to push closer and closer. The other side is that, the scientific discoveries are sort of out there. And so, in the scientific community, a lot of this is open source. You can kind of get your hands on the latest research. And it's frankly whoever at this point has more money and time and manpower to pour behind their position in quantum. And that's what we'll see play out.
But I guess my question is does it matter? Do you think that this is actually driving flows, or do you think it's just a narrative? I think if you're a boomer, you're a big asset manager and you read a report from, I don't know, some some research company that
it's a good,
and it's oh, Bitcoin has this massive quantum threat. Are you kind of rethinking your allocation plans? Or you just kind of
it's a good question. I think the scale to which the quantum problem is right now for Bitcoin is about the same as the asteroid mining problem is for gold. I would put those,
I would probably agree. They both sound extremely far-fetched to me.
I agree. I think there are some allocators that are seeing this and taking precaution and maybe, thinking twice. The point where I think this analogy actually holds up is that both of them are inevitable. They will. Yeah, I do. Yeah. I think at some point we will start mining asteroids. And at some point, we already know that gold is in some of these asteroids. We are going to do that at some point once we get drones and those drones go to space. It's not that far off.
Sounds so crazy, man.
At the same time, we see quantum advancements happening every year. There's a significant incremental progress towards a quantum computer. Whether that falls into the wrong hands or not, we don't know. But I would say that, both of these are at the same potential risk right now, but both of them are going to get increasingly more important. And so how do you weigh this as an asset allocator? I think someone has to take into account what is the risk that this could happen tomorrow? And I think there is a greater risk of that with quantum because it's a little bit more unknown. If we're going and we're mining asteroids, people we'll see the spaceships rise up. We'll see Elon talking about it. We'll see the drones get deployed. We'll know more of what's happening behind the scenes because we'll watch it unfold. And I think that means it's a bit more predictable. And so I think people that are asset allocating to gold can see this and they're okay, we'll have a little bit more heads up and we can reposition accordingly once we see those signs.
Yeah.
Quantum, there's a risk that this thing just sort of appears. At least that's the narrative. I don't think it's going to happen like that again. I think we're going to see the signs. We're going to see it coming. But because it's a little bit more vague, I think people see it as a little bit more unpredictable and risky. And so they're taking a bit more precaution.
All right, guys, let's move off of quantum. Move back into some of the neo finance conversation here with NYSC and more. This kind of hit the wire last week with regards to the tokenized stock movement. Ondo puts out, why is the NYSC going 24/7 a big deal? Ondo's president, Ian DeBode, explains how the move to 24/7 will unleash adoption of tokenized stocks. From my view, what they did with BitGo last week was the most impressive tokenization experiment in real time that I've seen in the last 6 to 12 months, which was just purely, all right, as soon as the IPO is live on the stock market, on the NYSE, we have a tokenized version on multiple chains, Ethereum, Solana, and others, that anyone in the world can buy on a DEX with decent liquidity, with a Wi-Fi connection and a Rabby Phantom wallet, and you can get exposure to this asset without having to go through a brokerage, all the traditional KYC processes and all of that. And so I just thought that what Ondo did last week with the tokenized BitGo launch was extremely impressive. And it's a sign of that tokenized equity movement that you're talking about with regards to quality assets, meaning that we're going to just get more of these biddable tokens on chain that aren't necessarily like crypto projects, but more of actual companies. Now, did I bid it? No. Did it perform well on day one? No. But the idea here is that now anyone has access to that, available day one. Now, the next logical step here is how do you give people access to pre-IPO markets at
HIP-3.
scale, at size? How do you allow me to buy into Bitcoin before it launches? And then how do I then sell it when it launches for a profit, right? Almost like pre-sale style on stocks on chain. Like if we get a pre-sale market going on chain where like actual institutional investors can only, like, imagine you didn't get into the Bitcoin any of their funding rounds, but then you're able to like buy a pre-sale on chain that was marked lower than the launch price, and then people on chain start to make profit without like that institutional people couldn't. That's like a massive wall that will be smashed through. And so that is what I'm looking forward to. But yeah, I thought this was great. I thought the 24/7 shift is awesome. And yeah, I just have a lot of positive things to say about that launch last week.
I'd love to see it. I just don't think it's going to happen anytime soon. I think in order for a company like BitGo or any company that's going and IPOing, they're going to have to set aside an allocation of their company's shares to essentially do an ICO and do a public sale on chain. And I think that would require massive amount, like regulatory shift. There's so much red tape and bureaucracy when companies are IPOing that, it would have to have a carve out for all these S1 filings to then allow a price discovery mechanism on chain. I just think that a lot of these companies see a lot of value in IPOing. And yeah, they can go and they can natively issue stocks on chain. Like we've gotten that far and that's great. But as far as a pre-sale, I don't know. We're going to have to
Or it's
do
just
quite
like
a bit
pre-IPO
more work.
markets. I think they might be on Hyperliquid as well.
Well, these are derivatives, and that's totally cool. Like we can do that. We can have an Oracle price and resolve it based on this and have a funding mechanism and a funding rate, and that works. And then once the IPO is live, we can pull that price on the NYSE, and we can use that price as an Oracle price in the Hyperliquid market and turn it into a spot market. That's how Hyperliquid HIP-3 markets work, and that works because the preemptive price is the pre-sale is a derivative. What you're talking about is physically delivering them the asset, not a paper contract derivative of the asset. And that is where I think you have to set aside that beforehand, and you're setting that aside knowing that there's going to be a different price, and there's going to be some price dislocation between the New York Stock Exchange or the public market and the on-chain market, which I think requires a lot of market structure clarity, which we do get in the Clarity Act, which I think is going live sooner than we think, but that is still going to take some regulatory changes. But I think it is something that if you take a second look at it, you don't need the price dislocation before the thing actually launches. Like now we have BitGo tokenized stocks, we have other tokenized stocks on chain, and then you also have the publicly listed equities trading on markets. That creates some of the, like, if you look at some of the largest wealth effects that have taken place in crypto, it's been a result of, take SBF, take Arthur Hayes. They both started by buying Bitcoin in one jurisdiction, flying to another area of the world and selling it in that jurisdiction. Similarly, I think, we had this whole multi-chain interop, like sandwiching arbitraging thing, which market makers did extremely well on. Market makers took centralized exchanges and decentralized exchanges and arbed the two and made a killing. I think there's going to be a whole industry that's born and it's probably going to be capitalized by a lot of the sandwiching bots, the MEV bots, the market makers that are on chain now. They're going to be doing tokenized stock and public stock and on-chain stock arbitrage. And I think that's a massive market that we haven't seen because a lot of these assets don't exist in both worlds.
Yeah, I mean, they don't.
Will.
And that's the beautiful thing. And yeah, man, I mean, once again, praising Ondo for that launch. I thought it was really, really cool. Let's keep it going before we have our first guest in about 5 minutes. Moving on to a unfortunate situation here in DeFi. Matcha Meta SwapNet exploit. $16 million drained. I've been seeing more and more of these as of late, actually. So again, there was a swap net incident here on chain, and yeah, I think if we scroll down here, we can get a bit more detail. But effectively, just another exploit in DeFi. It's hard to write off some of the smart contract risk that still exists in DeFi. And yeah, I mean, it just effectively, again, it kind of comes down to these infinite approval situations. And yeah, I mean, it's just that DeFi is still in this phase. The good news is a lot of these hacks are really small. Like 17 million is not a lot. Is not a lot comparatively to what we saw in 2021, 2022 hacks, but it's enough to kind of set people off and just kind of turn you off. So I don't have much to say about this. I'd like to actually move into the next one, but I don't know if you have anything to say, Rob.
No, nothing to add from mine. I'm not too familiar with this project or how it got exploited, so we can move on.
Yeah. Yeah. Well, it's just unfortunate. Just always be careful, right? Like there's certain DeFi apps that you want to use and certain ones that, you know, you got to be careful of using. And the infinite approval is the big thing that you guys got to be careful about. Like when you go on Rabby and do the approvals, you got to be careful. So let's move on to Circle's USYC. Passes BlackRock's BUIDL. Wow. How BlackRock lost control of the $10 billion treasury market to Circle for one simple mechanical reason. USYC hit 1.69 billion AUM on January 22nd, narrowly topping BUIDL's 1.684 billion. The real advantage is buried in the collateral rails. Interesting headline. Let's scroll down and let our viewers understand. Pretty insane headline, though, I would say.
Yeah, let's see what we've got here. Tokenized U.S. Treasuries crossed 10 billion. Wow, all these guys want us to subscribe. So something happening underneath this achievement. Circle's USYC has edged past BlackRock as the largest tokenized treasury product, signaling that distribution rails and collateral mechanics now matter more than brand recognition in determining which on-chain cash equivalents win. And so
yeah, I mean, so
past this, let's see.
The gains were driven by simpler structure, better exchange integration. Also, there's a lower minimum for USYC. So in order to deposit into USYC, you only need 100K minimum versus BUIDL's $5 million minimum. You also have an accumulating interest model on USYC versus a distribution-based yield. Also, USYC is available to non-US investors, whereas BUIDL is only available to US qualified purchasers. USYC was also able to have an early Binance off-exchange collateral, which supported their adoption and really kind of improved it. Also, of course, USDC's ecosystem is very integrated on chain. Generally speaking, this just signals a growing competition in the tokenized treasuries market, right? I mean, there's just a lot to be seen here. And yeah, I mean, this is awesome. I mean, I love to see this competition. I love to see that this is going to keep happening. And it's kind of insane that BlackRock is losing to Circle. And Securitize and BlackRock are going to come out swinging. They're not going to let this thing shutter. But yeah, we shall see.
We're going to see a lot more of this. And so I think, you know, the question that people are going to ask is like, hey, I've been in crypto a long time. You know, I drank all the Kool-Aid of ICOs and ETH L1 killers, and I bought the tokens and I did all this. And now it's great. Institutions are here, but how does that really help me? Like, how, like what does Circle's tokenized treasuries fund do for me, this guy that's been in crypto a long time? Like, how do I, like, what do I do here? And I think, I think a lot of people are thinking like, you know, this is great to see an adoption of technology, but you know, there's not a windfall that's going to come just because you're on the chain, right? I do think if you're looking at, you know, where can you position to successfully capitalize on this trend, because we know it's going to continue. Well, you can kind of take two different formats. You can take the format, which is like, look, these are good. These are reputable companies providing good yield. Like, I think BUIDL, tokenized treasuries, like they're going to get you, upwards of 5, 6, 7%. I think treasuries are, somewhere around that 4 to 7%. And if you have size, then you can capitalize and compound, with a reputable product. And you can even leverage loop these things up very safely, right? And so like Aves Horizon, there's other RWA lending markets. You can get, if you don't have size, you can get size by leveraging up with DeFi products. And we expect a lot more activity to happen there. The other way to do that, and so you can get, a nominal yield of probably upwards of like 15%, 20% maybe by leveraging. Do your own research, not financial advice. Don't listen to me about leverage. The other thing, option that you have here is
guy, guys.
is ETH, right? Like that is where a lot of this is happening. BlackRock has come out and said they think there's going to be one chain to rule them all. Like you can still try to pick winners that you think are going to profit as a result of this trend.
Yep.
And this is the category of assets that we think, fall into neo finance, which is at the convergence of this trend. And so, if you listen to the show, you've seen the likes of, the Maples, the Skies, right? The ETH Hyperliquid, like that is the assets that we repeatedly talk about. And there's a reason they continue to come up. It's because we believe that, this is where the puck is headed.
Yeah, man. I mean, look, this competition is just going to keep heating up, and excited to watch it play out. And I expect trillions. Like they're at 1.5 and 1.6 billion respectively. I think these things have a chance to grow by a matter of 50 to 75% year over year this year, putting them closer to 2.5 billion each.
How much do you think that like trickles down to like ETH? Or like if this, if Circle and BlackRock were to tokenize their money markets on Canton or like another Aptos or Avalanche, like
that's the thing is I'm not really sure it does
at all,
which is the weird part. Or just like not in the way that you would think, like direct value accrual to ETH, like it's like fully like I don't know. So
it feels similar to Bitcoin in the sense that like the value of the chain is growing because like
yes.
You're growing, this like thing is continuing to bulge, but as it grows you have less velocity of these assets. Like you're seeing less back and forth in transactions, and that's where these fees are taken. It's not like a hedge fund that charges 2 and 20 and just sitting there in the same asset. You don't have to make a trade ever. You're still going to collect 2%. Like, that's not what happens here. So it still remains to be seen.
All right, guys, quick break, commercial break, and then we'll be right back with our first guest Kevin, the CEO of Delphi, talking about the Neo Finance market map, talking about neobanks. He's a big Kita bull. We're going to hear his thesis and more. Be right back, guys, and let's get cranking with our guest lineup for the day.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more. All right, guys, we got Kevin Simbach, the COO of Delphi Labs, friends of the Rollup and of the show. Kevin's first time on the show. We're talking neo finance, Kita, neo banks. Kevin felt a little bit snubbed by our Neo Finance market map that went painfully, excruciatingly viral without his lovely, lovely bags on it. So we brought Kevin on the show today to talk about the category as a whole and more. Good to have you, Kev.
Yeah, thanks for having me. Great to be here.
Absolutely, man. Yeah. So, I mean, tell us about Kita. What is this? Why does it belong in the Neo Finance market map? And, you know, we've been talking about Neo Finance for quite a bit. So excited for this one.
Yeah, happy to tell you more. And let me just start off with the disclaimer. I do hold some of the KTA tokens. Delphi, as a ventures team, we have not invested in them. I'll give you a little bit of the story on the investment history of Kita. So there is really no institutional connection between Delphi and Kita. We've written about them a couple of times, so just wanted to get those disclaimers out of the way. But I guess, like, just start. To understand Kita, you really have to think about the context around institutions coming on chain. So TradFi, or I heard you say it earlier, we'll call it legacy finance now. This trend is undeniable in terms of the institutional adoption that's going on. Like, whether you love it or hate it as a crypto native, that trend is here to stay. And you've got these big institutions, some of which are going to come in and want to build their own chains. To JP Morgan's of the world, Stripe with Tempo is another good example. But there's tens of thousands of financial institutions in the world, and the majority of them, they're just not going to build their own chain. It just won't make sense. And so, for example, you've got a regional bank. Are they going to really use JP Morgan's chain? Probably not. And so the choices then are you use a public blockchain. And we're starting to see more institutions starting to put value and do transactions on Ethereum, Solana. I'm sure you guys have chronicled a lot of that. We've all seen the posts and headlines. It's actually, you know, pretty amazing to see how far it's come. So now let's talk about Kita, because what they've built is really, it's a purpose-built blockchain for this exact scenario of bringing the long tail of financial institutions that are looking to transact and bring value on chain. And when I say purpose-built, there's 4 key things that I think make it stand out. And what really popped out to me when it first got on my radar and I first started looking into it. One, of course, it's credibly neutral. So it kind of takes away that idea of going on a competitor's chain. It's highly performant. And when I say highly performant, we're talking multiple orders of magnitude better than any chain that exists out there. It's the fastest blockchain ever built. They did a stress test in partnership with Google. It was audited by, I believe, ChainSpect. They recorded 11 million transactions per second. They've got 400 millisecond settlement time. I'm not talking block time, but settlement time. And so it's the most performant blockchain that's ever been created that's gone live. It has compliance built into the core. And if you come from the legacy finance world or you interact with them, you know how important this is. They're just not comfortable bringing a lot of use cases on chain without having the right compliance attributes. And Kita built that in from the start. And there's a couple of things that we could talk about around that. And then the last thing is that it's designed to be completely interoperable. And I'm not talking about like bridging from one chain to another. I mean interoperable across all blockchains and off-chain payment networks. So you can do seamless, compliant, atomic swaps from effectively any asset. We're talking fiat into crypto coins and back and forth. That's kind of the things that it's designed to do. And they have some interesting tech that they've built that allows for this interoperability. And so all of that just kind of sets up Kita to be this vision they have as being the unifying settlement layer across crypto and legacy finance. And there just really are not many projects out there that have this ambition and are so perfectly positioned for this institutional adoption of blockchain. So I'll pause there.
Yeah. How would you compare something like Kita to something like Canton? Are they separate ideas? What would you think of it as like the core differences?
Yeah, I mean, Canton, I look at them as bringing certain asset classes on chain and being able to record like all of the transactions associated with the digital versions of those assets on chain. What Kita is trying to do is cover a bigger and wider canvas. So it's I'd say more analogous to being able to be like a big payments network, like a Visa, plus all the capabilities of being a bank itself.
Yeah. This neo banking category of like this convergence between DeFi and legacy finance at its core, better UX. Users want a forgot password button. People want to have access to on-chain yields and products. It's happening, but it also feels like there's a lot of competitive pressure, specifically at this neobank level. I think I think we've seen like the rise of the fintechs and then kind of like the crypto native neobanks. As it pertains to like this neobanking category specifically, like what is your broader view of kind of how this may shape out, right? Like at the end of the day, the yields on chain are all the same. So there's a commoditizable layer there. That a lot of these like apps on your phone, they look very similar, right? That they feel very similar. They're all free. They all have, they're all in the app store. A lot of them have a Visa card. There's some competition on like cashback and rewards and loyalties. How do you see, like I just don't see there being 25 successful neobanks targeting the same, niche of users. Like, how do you see the neobank category kind of unfolding over the next year or two? I'm not sure if Kita is really positioned here or if they are, or just kind of like generally how you think about this from the likes of like Plasma, EtherFi, Revolut, Venmo. There's kind of like separate categories here, fintechs and crypto native banks. How do you think about this category?
Yeah, I mean, first of all, I like the products. So I'm a fan of EtherFi, been using their card for a little bit. I know there's a bunch of others that have started to come about, but most of these, we have to just remember, are just kind of wrappers around your crypto assets. So they give you a vault, you earn some yield. When you want to go spend it, they link you up with a debit card that pulls from, a vault of some sort that they've got set up, allows you to spend. There's really nothing super special about that. It just is sort of a better user experience for people who keep assets on chain. Now, when we talk about Kita, they're kind of coming at this from a more of a legacy finance perspective in terms of building their infrastructure. So they announced a week or so ago that they're in late stage talks to buy an actual bank. So that's something that we don't see neobanks out there doing. They're building these wrappers around a user experience and giving people debit cards. They don't actually go and own and buy a bank. And what Kita is trying to do is bring an actual banking license to its product set so they can have the actual issuance of fiat banking accounts. And then with that, they can tie that completely on chain and then open up the use cases for everything they're doing with the blockchain that they've built. And so it allows them to do something like they've talked about. There's some products that they're launching that are in the works, one being Kita Pay. So very similar to Venmo, you've got sort of a username, you want to send somebody money, but you'll have the ability to send somebody any asset that you want. You can send them any currency, you can send them crypto. It's a quick, seamless transaction, just like you see with Venmo today. They'll have a card that you can do all the same things that you can do with these other neobank cards as well. They have partnerships with Bridge and with Agora. So the seamless interaction between on and off ramps and into stable coins and out of stable coins will be far more seamless. So I think what they're going to be able to do is far more than what these kind of existing neobanks that we see today that more or less just offer a vault with a tied in debit card.
Yeah. And you are pointing to this kind of dispersion where there's a few different dimensions we can expect a lot of these neobanks to differentiate on. One of them is, are they going more into, they're going to get a banking license, they're going to be, issuers of credit, create these money accounts and kind of, add to the credit supply. The other ones are, you've got Robinhood, right, which is kind of playing with this financial super app concept, probably won't end up getting a banking license, but, obviously has a lot of deposits held on its platform, and then also offers a breadth of financial products and assets beyond just holding cash. And so this is another dimension through which we believe a lot of these neobanks are going to differentiate. It's like, okay, are you, kind of primarily offering these like yield savings rate sort of payment options, or are you then offering a lot of financial services to go invest, into speculative assets, whether that be tokenized stocks, public markets, or, the Bitcoin crypto assets on chain? How do you see this kind of falling out from, is there anywhere else that you think that there's differentiation points? And then I guess where does Kita fit into this stack?
Yeah, when you talk about where Robinhood's going, and I think Revolut's probably in a similar category, they're kind of going after this super app concept. So they want to be the place where you store as much of your wealth as possible, and you have the opportunity to put your wealth in any type of asset that you want. And that's great, but you're also operating within Robinhood's walled garden. Like they are, the complete owners of their platform, and so they can do things like what they did during the GameStop era, and sort of control how everything works on their platform. What Kita is enabling is for this to come together in a permissionless, decentralized setting. So Kita can go and build some of the core apps. They can have the banking license, all of the blockchain infrastructure, but at the end of the day, it is an open network. So other builders can go and build apps. They can plug in, they can take advantage of all of the unique elements of the Kita tech in their blockchain network. And you could theoretically build the super app in a more decentralized context on Kita network. So I think they're kind of both pursuing the same vision, just in a different way. One being a fully permissioned walled garden network, the other coming at it more of a decentralized ethos and trying to build the core foundation of the infrastructure, and then bringing together an ecosystem that allows for all of the elements to come in.
Yeah, I just wonder like how much of these fizzle out in the coming years, right? Like if the super app thesis is the objective for some of these companies with the largest distribution, then you ought to think that someone's going to win that, and someone will create that kind of super app concept. And yeah, I'm just not sure if it's going to be the crypto native companies like Kita, like ETHFi, et cetera, going and winning distribution and winning these banking deals, buying a bank, as you said, or licensing agreements, or if it's going to be the more fintechy companies with the distribution getting the best access to crypto products first. It's kind of like this, they're starting on two ends of the spectrum and kind of racing to the middle here. One thing that I think is particularly interesting, though, is that I think there's differentiation possibilities here on the types of users, right? So like there's I think whoever wins the wealthy crypto user segment over the next 10 years is going to win big, because you don't really need that many actual like quantity of users, as long as the actual spend and the actual amount of dollars that people are transacting in their app is high per customer, rather than like a lot of customers with a small amount. I just find that I think that everything else equal, like the winner is going to be the ones who is going to actually get a really strong grip on like the wealthier new investor class, less so the older investor class, and less so just kind of like anyone around the world. I'm sure there's going to be like there's huge neobanks in Brazil, for example, that have tens of millions of users. But again, like the quantity per user in terms of the dollar amount transacted is lower. I'm thinking that the main edge here is going to be in who can get the younger generation, wealthy kind of new money users to really be sticky.
Yeah, I won't disagree, but I'll come at it from a slightly different angle. I think that the winner, at least in the crypto side of things, will be who can appeal to people that care about self-custody in a material way. Because at the end of the day, and you see where things are going with the fiat debasement trade, where things are happening just geopolitically across the world, I think that that's going to become more important. We saw the privacy trade be a big thing. I think more people are going to wake up to what the importance of self-custody is, at least for a percentage of their assets. Now, if you care about self-custody, then a super app via Robinhood or Revolut doesn't really work for you. Maybe that works for some of your assets. And so I think there's a world where you can have multiple winners in the super app. I mean, first of all, there's a lot of people in this world. There's a lot of wealth. There's nobody. It's not a winner take all. There's going to be a bunch that can be very successful. And I think that there will be a growing trend towards super apps that can also accommodate people's desire to have self-custody. And that's where I think Kita has an opportunity to carve out space to be working towards a super app ecosystem that also supports self-custody in a big way.
Kevin, I would push back on that a little bit and just say that, where self-custody is important is in areas of hyperinflation. Like Andy and I, we were in Argentina, maybe we were there too for DevConnect, and we spoke to people that were like, yeah, stable coins are real. Self-custody is real. Like there are oppressive governments out there that are hell-bent on taking as much power and money from the people as possible. And, they will come for those people's assets. On the other hand, we've got, we've got sort of where a lot of wealth is held in, more stable government countries with more stable governments. And so in order for, I think for both what, Andy, what you're saying, and Kevin, also what you're saying, for these two things to be true, there would need to be some cataclysmic event in a country that has a stable government now that does destabilize. And that's where a lot of like this younger, wealthy generation exists and lives. And for those people to say, yeah, we don't have trust in our government to, leave us alone and not seize our assets, there may have to be something that happens that causes this like paradigm shift in thinking. Because at the moment, it seems like where self-custody is most important is in places around the world where like there are unstable governments that have a higher likelihood of seizing their citizens' assets.
Yeah, 100%. It's definitely going to be more appealing to people in places that have that kind of risk. I think even in stable places like the US and other parts of the Western world, you're still seeing people that do care about self-custody. Now, I guess I'll be on the side of, I think that self-custody trend will grow over time. If we start to see more things continue to destabilize across financial markets and geopolitics, that trend of people caring about self-custody, I think, will grow. And that's where I feel like if you want to be in a growing market, if you want to build something, find out what people care about and try to build in that space. And if you're building a super app and you have an opportunity to seamlessly integrate self-custody options for some of your assets and be able to move seamlessly in and out of that for a lot of your financial needs, I think that's an attractive place, and it's a niche that Kita or others might be able to carve out.
Yeah. It's kind of a weird place to be in. Like we believe in the debasement trade is happening, right? Like we have Bitcoin as a significant part, like all of these things, especially the gold trade as well. All of this is the debasement trade. And if you hold those assets, you're kind of betting on the destabilization of the world.
Yeah. Kevin, did you hit the gold trade?
I did for a bit, and then I got out of it for most of it, and then it just has continued to run, and it never gave an entry. Like from 4K to 5K when it started to run again, it never gave an entry. So yeah, sadly I missed out. I'm on the copper train now.
Nice. Are you more of like a longer term, like bot, like I guess where has most of your gains come from in your investing? Is it just from like these longer term holds that you guys have done through like the venture side? Is it through like multi-month swing trades? Is it the majors? Like what has been like the strategy that's allowed you to kind of fundamentally hit big winners in the market?
Yeah, all of my big winners have happened when I've had conviction, held for a long time, and gone in with size.
Yeah.
And I'd say once, maybe twice a year, I kind of get something that feels like it matches that criteria, and I do that. Where I've undeniably, no edge is doing short-term, low time frame trading. Like I just don't mess with that at all. So I think it's just about finding the places where you have really strong conviction, and then not trying to diversify too much, like actually concentrating a bet in a place that you know a lot about and have high conviction, and just, going in with size.
I agree. I've retired from perps trading. I've retired from short-term trading. The best wins have always been from multi-month to year, maybe 18 months max. You get a really strong conviction on something. But man, Kevin, it felt like during Pump.Fun and all of this, the market shifted from like being early with fundamentals to like, oh, I'm just going to be the first one into something, and then like be one of the first ones out. So I'm glad that you're here on Kita, still believing. I think we need a bit more belief in this market. When it comes to the broader market, you're starting to see that there's not that many tokens that you really want to hold. And you're starting to see that there's also like, the magnificent 5, 7, 10 being created here, I think, especially this year in the space. I don't mean to ask like, are we going to see an alt season again? But I think like the more prudent question is like, how has your investing framework as far as allocating to the market in terms of diversification changed over the last 5-7 years, right? You've been around for quite a while. I think you're part of the original 7 there with Delphi. So you've seen a lot. What is like the diversification kind of allocation strategy change, even maybe just in the last 1 to 2 years? How do you think about that going forward with your own portfolio?
Yeah, I wasn't fortunate to be part of the original 7 that got in with Delphi. That would have been a great time,
Okay.
Crypto, but have benefited a lot from working with these guys over the last 4+ years. In terms of diversification, I mean, I spent 15 years before crypto in traditional normie kind of corporate roles across consulting and big tech. And so I just put money into diversified stock portfolios and then had a bit of a trading account on the side for things that I was really into. And I would say when I got into crypto, the biggest mistake I made kind of back in 2020, 2021 and stuff was just spreading myself too thin. I end up with smaller positions across too many coins. I'm not managing them very closely and figuring out and seeing what's going on and staying on top of them. And now I find myself being much more concentrated, and I want to have good information advantages or edges around the things that I hold. And when I look across the crypto landscape, I don't see too many things that I truly want to hold. I mean, there's the sad reality of where we are with altcoins right now. So I have, like many people over the past 1 to 2 years, have diversified out into a bit more stocks, metals, AI, and private investments outside of crypto. And then I've kept my crypto investments quite concentrated, Kita being one of them.
Yeah. No, I hear you, man. I hear you. Kev, last thing for you. When it comes to Kita, is this a multi-year trade for you? Is this what's your time frame on this thing?
Yeah, for me, this was never one that I was going to get in, ride a quick pump, and get out. I felt like I really resonated with the vision that they had, and I believe I kind of treated it like a VC investment.
Yep.
So the lore behind Kita is they fair launched their token, I believe it was March of last year, and they did it at a super low value, just kind of stealth launched on chain. 40% of the token supply dropped. A lot of people, they thought it was a scam. Then it turned out that, like, legitimately they were backed almost entirely by Eric Schmidt, former CEO of Google, as their primary investor. They've been building since 2022. And the more I got to learn about it, I said, this is going to be volatile. I'm just going to put some away, treat it like a VC investment, and expect that liquidity will come in 3 to 5 years.
Yep.
And so that's how I look at that one.
And what would make you change your mind on this position?
Yeah, I mean, I do follow what the team does in terms of their roadmap. Are they executing? And whenever I see execution plans start to go off the rails, so they're not hitting milestones on their roadmap, they're not communicating very well with the community and sharing updates, they kind of go quiet for a period of time. There's no new announcements of things that they're working on. I kind of look at the execution speed and the quality of what they're executing, and as long as I see that, it still is wowing me. And the thing of just last week of acquiring a bank and what that adds capabilities kind of is another one where I say, okay, that seems like they're still cranking. So yeah, when I see execution just sort of fall off and teams go quiet, that always makes me nervous.
Yeah, man.
Kevin, give us a quick sense of what 2026 has in store for Delphi.
What are you guys cooking?
Yeah, man. I mean, things have been quite good across the division. So the consulting business that's tied into Delphi Digital, the research platform, has been working with more teams and really helping around things like economic design, doing tools to help teams really think through how to properly launch a token. We saw last year so many token launches just go miserably poor. We saw the ones that worked out well, tended to have some interesting dynamics around supply control that may or may not have been kosher. I think teams still just can't figure out how to properly launch a token and manage that process very well. So our consulting side is very busy helping lots of teams trying to think through that. And then on the venture side, we continue to be active. We look at pretty much everything that comes through. I think we're more selective on crypto native deals these days, as are many of the VCs that I continue to talk to. We just want to see the bar raised, and we want to see valuations come down to a bit more realistic levels. I think they got a little bit inflated in the 2023-24 era, and maybe a little bit of correction in 25. But yeah, ventures is still quite active. And then on the Delphi Lab side, we are focusing our efforts on a couple of projects we've incubated, and Legion being one of them that's kind of like our baby. There's a couple of others, one we're going to be announcing more about. It's probably the most ambitious project I've ever seen come through crypto. It has to do with AI data centers and a tokenization element with that. So we've been working behind the scenes on a couple of really interesting projects that we'll be announcing more about later.
Very cool. Awesome, man.
Man, Legion's epic. I'm so glad that they've had so much success. And for a while there, Echo was kind of like, on their tail. And then now that they've gotten acquired, it feels like there's like Coinbase hasn't done an ICO through their platform in the last 2 months. Legion's kind of the one, I don't know. They're kind of like the last man standing. So, yeah.
Yeah. If you like what Legion has done for helping bring capital formation to crypto, you're going to love what they do next. So stay tuned.
Love it. Kevin, man, thanks for your time.
Right.
Have a great week. Have a strong week. Have a strong first half of the year. We'd love to have you on in a couple months. Get a refresh on Kita on the finance category and just see where we're all at.
Yeah, really appreciate it. Thanks for having me.
Thanks,
man.
Kevin. See you next time. All right.
Well, there you go, Rob. You got your question answered about what is Kita.
I mean, backed by Google, Eric Schmidt buying banks. Like, we know that in order for a neobank to have any sort of edge, they have to have distribution. Like, a lot of this is going to be, what is a neobank? They're going to be providing payment rails, and they're going to be providing some pretty stable source of yield. Maybe that comes from off-chain, maybe it comes from on-chain. A lot of these apps are going to look really, really similar. So how do you differentiate, right? If it's not tech and it's not product and it's not user experience, like, it's the only differentiation is you have to, get that into the hands of the most people.
Right. Which is why the super app thing is a little bit scary for any of the crypto neobanks, because if it really is a distribution game, then, well, yeah, we're looking at Robinhood, we're looking at Venmo, we're looking at Revolut, we're looking at some of these others. But I don't think they have as much distribution globally, which is where I think a lot of the edge can come from. And then again, I truly just think that the actual crypto native users that are wealthy will drive a lot of value for something like EtherFi, like these other neobanks, compared to like the less financially savvy average neobank or fintech user.
I'm starting to see a divergence between neobanks and super apps. Like,
kind of, though, they're trying to play the same game. I'm telling you, like the fintech super app is the game that all the fintechs are trying to play, and the crypto native neobanks are trying to do the same thing: earn, spend, save, transfer.
Yeah, I mean, a super app is going to verticalize the most, but I think they're going to have the most trouble doing it. Like, if you do have a super app, you're going to end up with like everything on one. It's just, there's not a lot of winners in that game, in the super app game, but I could see how there is more winners in the neobank world, because you end up kind of chomping off and carving up this market with more niche. And I do think that there's enough segmentation in the market with regards to assets. Like, the user experience for an app that gives you just plain cash plus yield is going to look a lot different from the one that gives you access to, private credit for different forms of yield, gives you different levels of choice, right? And so, yeah, I think within neobanks, if we end up kind of going in the financial super app world, there's going to be very, very few winners. And I think the cast of characters, the fintechs, the Robinhoods that you mentioned, are most likely to win the super app game. But if the game is more like this neobank world, where, look at banking right now, you have too big to fail banks, and then you've also got a long tail of community and regional banks. And so I think if it's the neobank world, we end up looking a lot more like the current banking world. If we go and, these guys don't want choice and they just want simplicity, and that's what this world ends up looking like, super app, Robinhood, that's where we're headed.
Yeah. We got Moody coming up, the lead developer at Cubo Protocol. Let's bring him up. We'll talk things Neo Finance. We snubbed DEXs in the Neo Finance market map. I'm not sure Moody's going to be too happy about that. We'll get his perspective on the category, hear what he has to say about what's going on the Cubo side and more. Moody, what's up, man?
Hey, thanks for having me on.
Good to see you,
It's a
buddy.
pleasure.
Are you a Neo Finance bull, or is this just not going to work for you?
To be honest, I hadn't heard of it, but I could be convinced.
So Moody, we've sort of seen like this convergence where, you know, for a while there was Web 2 and Web 3 was sort of this evolution of Web 2. But more recently, we've seen how like Vitalik is talking about low risk DeFi. We're talking about how a lot of these tokenization platforms are bringing stable coins and RWAs and different sources of yield on chain. And we believe that for this, what this looks like in a mature sense is it looks like a lot of the companies with massive distribution of the current legacy financial world, Wells Fargo, Bank of America, like the massive Robinhood, a lot of these guys with massive distribution end up tapping into DeFi in the back end, you know, as they're kind of forced to innovate and pay higher yield to their customers. And that's what we're calling neo finance, kind of this convergence of like legacy finance, distribution and front end with high yield DeFi composability in the back end. Tokenization is sort of the upgrade that allows this convergence to happen. And so neobanks are a part of this. That's what we were talking about beforehand. Stable coin, tokenization, all this is a part of this. And actually we've had people reach out to us and be like, we released this market map with all these categories kind of laid out, but we didn't include decentralized exchanges. So we've had people reach out to us to be like, where are the DEXs? Like, why are they not included in this grand landscape of where, you know, this space is headed? And so, you know, kind of putting aside the term itself, I'm curious as to where you see decentralized exchanges fit into this broader landscape of legacy finance, stable coins, like how these things are fitting together in what we're calling the neo finance world.
Yeah, I mean, I can definitely see that, and I agree with that. I feel more and more like I'm working just like on regular like fintech backend stuff than I do like in some separate category of crypto, especially as crypto becomes more mainstream and more widely adopted. It's you know, I could see DEXs fitting in especially well for things like currency exchange, like you know, rather than going to an airport, you know, paying some absurd fee, you can do it with some decentralized exchange and pay a much lower fee. Yeah, I mean, it's the liquidity is there and it's free to use. So, I mean, not free, but it's much lower cost to use, especially because a lot of these rails are just more efficient in crypto. So yeah, I think I could definitely see it just being tapped into as the back end for some of these apps like Robinhood. And yeah, I mean, to me, it feels kind of like that's where things are going with Coinbase and Base. Like the Coinbase could just end up being a front end for the DEXs on Base. And I think in a lot of cases it is. Like you can buy some things on Aerodrome now from Coinbase. So yeah, I mean, the argument makes sense to me.
Yeah. Have you thought about getting more distribution for a Cubo through some of these types of front ends? Like, right, like I think another part of this thesis is that for better or for worse, DeFi power users clicking their ledgers on hot wallets and connecting their MetaMask and Rabby is not sufficient to scale this ecosystem further, right, to where we want to go. You know, we've seen this play out, right, with Coinbase is Bitcoin-backed loans with Morpho on the Coinbase platform. You've got a Hyperliquid plugged into Phantom. You've got Lighter is going to be powering Robinhood's Perps platform, from what I understand. How do you think about the distribution strategy for a Cubo, and where do you guys see the next set of users coming from? Because frankly, you know, as I said, for better or for worse, it's likely not going to be from the on-chain, you know, ecosystem as it is today.
Yeah, I totally agree with that. I think that's kind of like the key of like our V3 is that we can't do the distribution. We don't have control over the user. In a lot of cases, it's going to be a Web 2 user that's using Robinhood. So actually, we completely removed the DAO from the core contracts. There's no revenue collection from the core contracts in V3. And basically, if you're a Robinhood or a Coinbase, you can white label our core contracts and just deploy some of our pre-built code on top of them. And so if you want to build a DEX or an exchange that's based on AMMs, you can do that using Echobo's code, Echobo's deployment, and get all the advantage of the infrastructure we've built and the integrations without having to basically integrate directly with a DAO or work around like a protocol fee like you would with Uniswap. That's actually not even built into the core contracts anymore. So it's moved up a layer into the social layer with our new version. So we're hoping to get like distribution to these new users through partners now. So we have like an open source proprietary license, which says that if you don't collect any revenue, then you don't have to pay any fees at all. But if you do collect revenue from whatever you build on top of Echobo, then you have to share some of those fees with the DAO, and it's negotiable. So if you already have distribution, then that fee share might be much lower than it is if you are deploying a DEX to a new chain, for example, or building a new brand. So yeah, it's I definitely like, I think it's really hard to be an upstart in crypto and try to build your own distribution channels, especially when so many people are like vertically integrated. So working with partners is kind of the goal of the next version.
Very cool. Moody, you were at Uniswap and really integral in Uniswap v3. What do you think of the beef out there between Alex from Aerodrome and Hayden from Uniswap? Like, and generally, how do you see kind of the DEX wars playing out?
Yeah, I mean, I think I see a lot of valid arguments from Aerodrome, but I don't know if I'm like fully bought into like the Drome style economics for the token. I'm much more convinced than I was at like Uniswap, a few years ago. It seems like they're able to gain traction on a lot of new markets very quickly with the controlled emissions. And yeah, so I'm honestly still on the fence about which way is better. I do find the Uniswap style economics a lot simpler to understand. You have revenue from that goes to the protocol, and you have these emissions from incentives or whatever, or funding the team development. It seems a lot simpler to me that the LPs collect their fees directly. But yeah, I'm interested to see what happens when Aerodrome comes to mainnet. I also am building Echobo with that in mind. So because there is no protocol fee built into core, you can build whatever economics you like on it. You could keep all the users' LP fees and give them a token instead. Everything's possible with the infrastructure we've built. And yeah, the goal is that they're all built on top of the same infrastructure, and that just makes everything more efficient for everyone, gives better pricing, creates network effects, reduces duplicate work. I mean, you don't want to have 10 forks of the same code on the same chain. It's just a waste of gas, and the money goes to arbitrageurs and mevbots. So yeah, I'm hopefully we're positioned so that regardless of who wins, it doesn't make a difference.
Yeah, man.
Yeah, go ahead, Andy.
Oh no, I was just gonna say just kind of about the DAO shift. Is this because of like the token equity dynamic or the DAO governance dynamic, or like what has charged this decision to kind of change the way that the fees are being structured?
I would say it's a couple things. One, it's extremely difficult for us to get distribution as a new brand in crypto. I think it's very hard to sell users that this is trusted and secure. Also, the token is already out there, so people aren't there's not some like lottery style return where maybe the token will airdrop and you'll make $1 million or whatever. That I think that uncertainty actually is a big draw for these new applications. And since we've already launched the token, we can't do that. So that's one thing, and the other thing is actually just demand from people on StarkNet, for example, have reached out and said, "Hey, I want to build something with Drone style economics on StarkNet, but I can't build a whole AMM in Cairo. That's going to take me a year plus, especially if I don't have the experience." So switching the model of Echobo so that it's a platform where you can build your own DEX on top just made a lot of sense to me. It sort of solves both problems, which is like distribution. We can work with a partner like Sushi, get them to build on top of Echobo and take a fee cut, and they deal with distribution and branding and marketing, and even go to market in some cases. And yeah, the other part is yeah, I don't know, whatever I just said.
Cool. We've been thinking a lot of sort of this onslaught of what we think are more quality assets in the space. You were kind of ahead of this with some revenue share programs and baking that into Akubo, the token. Otherwise, like there's a handful of companies that are starting to realize that it's kind of table stakes at this point. And then you've got the larger tokens, ETH and Bitcoin and some of the L1s. Otherwise, there's not a whole lot of tokens that are like investable out there. And so, we believe that it's kind of this neo-finance push, but a lot of these institutions coming into the space are going to bring assets with them that ultimately appeal to a wider class of asset allocators and investors, whether it be RWAs or these tokenized yield products or tokenized stocks. Tokenized gold is like a $4 billion industry now on chain. Do you think there's any sort of DEX mechanics that are required, like to adapt our thinking, given that a lot of new asset classes are coming into the space?
I mean, the way I think of a DEX like Echobo is just like you can sort of choose how much you want it to be like an order book versus an AMM, just based on the tick spacing. You can choose a very small tick spacing, and I think they're very flexible because of that, and so to me, it kind of I'm not sure that something needs to change. I mean, I know that they don't work exactly like order books or centralized exchanges, but they're adapted for like a constrained compute environment, so they're not going to work the same. But like you can get a lot of very similar functionality just with a DEX, which has extensions. Like we even have a limit order extension on StarkNet, which pulls your liquidity whenever your order is fully executed. So in some ways that works very similarly to an order book. But I don't see that much demand for it. I mean, we deploy this limit order thing and it's not really used that much. We just have a handful of users on StarkNet. So yeah, I'm not sure what needs to come. I mean, it's I don't think we need like like market hour extensions or anything like that. Like I don't think we need to emulate TradFi to make it work. If anything, TradFi is starting to take inspiration from DeFi and looking towards doing I think 24/7 trading or maybe 24/5. I'm not sure exactly what's happening, but to me, like innovation has moved much quicker on chain than it has off chain, which makes sense because anyone can deploy a contract in seconds.
Yeah, I mean, I think the tokenization, the RWAs, and the stablecoin sectors are primarily where a lot of the the actual major flows are coming from. How do you see the evolution of tokenized asset trading on a Cuba, whether it be gold, whether it be tokenized equities? What's kind of like your roadmap or plan, or how much emphasis and focus do you want to actually put on these newer asset classes coming on chain versus traditional crypto assets?
Yeah, I mean, if I was good at BD, I'd probably focus on that. I'm good at dev, and I mostly focus on dev. But that's definitely. I mean, the amount of volume that's traded in those asset classes is orders of magnitude higher than crypto. So, yeah, if you really want to grow 100x, that's probably where you have to focus for someone as big as Uniswap, especially. Yeah, I mean, for us, we're trying to get a foothold in the market. We're trying to build a brand, and so yeah, we're trying to like prove value and grow our brand where possible. I think it's especially relevant today for things like buybacks, which are coming online for companies like Optimism. We have extensions that others don't, and that's where we're sort of focused is distributing something like TWAM for buybacks. I think it's a very elegant solution. It's worked very well for us for 2 years, and so yeah, I mean, we've made a couple of pushes to get people to use it, and I think just if we can get one big partner there, that'll make a big difference in terms of proving usefulness. But yeah, I like our strategy, our business strategy has basically changed from we're going to try and do BD and get partners to or like direct liquidity providers or like new markets or new tokens. We've changed from doing that to like trying to get people to build their AMM on top of ours, and they'll have their own distinct use cases. So you might have an AMM which is focused specifically on stablecoins, but it's built on top of Echobo's infrastructure. Or you might have one that's focused on commodities like gold, and that's a separate one which has its own extensions, but it's all in the same stack, same infrastructure. I think stablecoins in particular, we could see some traction for new stablecoins, especially because we have extensions which let you distribute fees directly to the pools that just came out, and that could be really useful for something like Bold and Liquidity.
Yeah. Moody, what's on the agenda for you guys for the next 3 to 6 months, Q1, Q2? Close us out here, and any closing thoughts as to what's coming for Cubo?
Yeah, so we just launched V3. We launched on Ethereum and Arbitrum. We're waiting for some updates to the OpStack chain so we can deploy everywhere. So getting Echobo infrastructure everywhere live and then integrated with things like CoinGecko. We just had a BlackRock's dashboard released. So basically just making it available everywhere just increases the value of our infrastructure, and that's what we're focused on. Integration with aggregators like 1inch, 0x, Paraswap, Kyroswap, just the basics on mainnet plus everyone else on all the other chains is sort of the key piece we're delivering in the next couple months, and then yeah, after that it's really about launching with these partners and making sure that all these use cases have someone covering them. And also helping them with their go-to-markets and that sort of thing.
Yeah.
Appreciate it, Moody. Yeah, I mean, you guys have been able to build, I think the most gas efficient DEX to date. And so it makes sense, as more activity comes on chain, they end up, going into some of these extensions that you're talking about. So great work on the engineering side. And yeah, always a pleasure having you on the show, man.
Yeah. Thank you for having me.
Thanks, Moody. Speak to you soon, man.
I'll see you next time.
See you.
Cheers, buddy. The distribution battle continues, man. It continues. Especially for DEXs, especially for perps. It's huge. That's the question. I mean, it's not only just like multiple chains, right? It's like it's full on, multiple front ends and upstarting full venues.
Yeah, I mean, you could even consider like some of the things that Moody was talking about as far as going and distributing his infrastructure, Kubo's infrastructure, into different asset classes and kind of segment, like just further entrenching and embedding a lot of this infrastructure deeper into, you're right, like a lot of the multi-chain, but also the legacy finance landscape as well. And a lot of that comes down to BD deals, distribution. Like there's going to be some kingmakers of DeFi products, with this vision of them getting integrated and embedded into legacy finance, and let them do the distribution part. they're just going to end up either acquiring or buying or, integrating a lot of these DeFi protocols that are going to end up. Some of these DeFi protocols are poised to do extremely well if they get the right integrations.
Yeah. All right, guys, we have our last guest of the day, Jess Halgrave of Wallet Connect. They've just launched an epic new product for payments and point of sale. So we're going to take a quick break, and we'll be right back with our next episode of Stabled Up and get into it. See you guys in just a sec.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on-chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to Kalshi.com to trade today.
Talk to AI like your lawyer or your doctor or your therapist. Yours, private, and here today. Visit near.ai to have a fully private chat experience.
Havachi is fast and private.
Welcome back to another episode of Stabled Up, our premier weekly show covering the ins and outs of digital dollars, stablecoins, and the future of decentralized finance.
The show is made possible by Frax, and Frax is powering the financial engine of the internet, powering FRX USD and Genius compliant stablecoins. This is the stablecoin super cycle made possible by Frax. Now enjoy Stabled Up, our weekly stablecoin show.
Alrighty, guys, welcome back to Stabled Up, our weekly premier stablecoin show brought to you by our friends at Frax, powered by FRX USD, Fraxnet, and more, a leading stablecoin provider in the crypto economy for the last 5+ years. Today, we have Jess Halgrave. We are going to be talking about stablecoin payments at scale. Wallet Connect Pay has been a big news in the neo finance sector from last week. Crypto payments are scaling, massive crypto card volumes. Revolut and neobanks are issuing wallets to the mass market. Traditional banks are enabling retail stablecoins, and Wallet Connect Pay is going to be offering cashback style rewards and more. Jess, we'll get into all of it, but first of all, how are you? Big week.
It has been a big week, one that we've been, working towards for a long time. I feel like I've been working towards it for a long time. I've been thinking about crypto and payments for many years now, and so very excited by it all.
Great, awesome. Yeah, Wallet Connect's been in the stablecoin space, in the multi-sig kind of wallet signing space, in the wallet and kind of user interfacing space, but it really feels like this is like a very like one-sided jump into where you believe the future is headed, which is payments for stablecoins at scale. And I think yesterday, actually, or the day before, Santiago Santos put out an article about why he thinks B2B stablecoin payments are going to absolutely explode. So let's just kind of start with some of the thesis here of the product, and then we'll get into some more of the actual specs and details. Why are you so bulled up on B2B stablecoin payments? Why is this going to happen? Why is this going to work? Talk to us about why this specific niche is set to grow big time this year and into the end of the decade.
Like, I think we see people moving on chain in all the various like form actors and across all of their business lines right now. So businesses are moving on chain and managing their treasury on chain. As a result, people are going to be wanting to pay their suppliers, pay their employees with assets that live on chain. We saw the zero hash Gusto announcement for contractor payouts. People are going to want to get paid in stablecoins, and with Wallet Connect Pay, really what we're doing is building on top of our existing network and our infrastructure, which accesses about 700 different wallets, many thousands of applications already built on the network, and makes a really seamless payments flow for consumers, so that when they go in store with an Ingenico partnership or with any of our other payments companies online, they're going to be able to pay for goods and services with those assets that they now hold.
The Ingenico partnership, I think, is one that caught a lot of people off guard and was a wow moment for the whole industry. This is something that I know I go into restaurants and shops, and I see this as the point of sale provider. And so to associate that with Wallet Connect was a big eye opener. Give us a deeper sense of how it works underneath the hood. I tap my normal card. What is the process for businesses to onboard Wallet Connect Pay? Do we kind of get all the Ingenico ones by default? Are you going to be going to businesses and kind of picking them off? Tell us a little bit more about the ins and outs of this product.
So the end user experience with Connect Pay, you scan the QR code. Instead of a traditional crypto experience where you're asked to connect your wallet and then sign a transaction, you're taken through what feels and looks like a payments experience. So do you want to pay with this asset? Yes. Click pay, one and done. You don't need to think about anything else. And you can pay with whatever asset is in your wallet. On the other side, unfortunately, it's not tomorrow on all Ingenico devices, but it will be a gradual rollout with both their direct merchant partners and, of course, also with their acquiring bank partners and payments companies. So they cover about 40 million terminals worldwide today, and we will hopefully one day be in all Ingenico terminals. But right now, a merchant either needs to opt in directly with Ingenico or ask their PSP. And we hope that a lot more payments companies, we've got several in the pipeline, but we hope that a lot more payments companies are going to switch this on in the coming years, because we do see demand from merchants, because they want to be able to offer this to their end users, gives them lower fees, faster settlement times, often higher basket value, higher transaction value for end users. So tons of reasons why the merchants want it, and why those PSPs should consider enabling it.
You've argued that with regards to the payments, for actual consumers to be interested in using some of these payments, right? Cashback style rewards is interesting, and I'd like to get into that. But when it comes to the B2B payments landscape, when you're explaining what you guys have built to other enterprises and businesses, is it as easy as saying faster settlement times, cheaper fees, instant payments, more profits for your business, less money paid to a credit card provider, less fees paid to a Stripe? Or what is that conversation like as far as understanding and educating about stablecoin based flows using Wallet Connect Pay?
So for most merchants, I think it's very unlikely today that any merchant is going to say, right, I'm only going to accept crypto. That means that this needs to sit alongside their existing payment methods. And for a lot of merchants today, they will accept card, they will accept cash if it's in store. If they're online and e-commerce, then they probably accept other things like Klarna as a buy now, pay later method. They might accept other account to account based payment methods like open banking in the UK or Trule or anything else. So already in existence are hundreds of different payment methods, and very few of them are global, mostly just the card networks, and the alternative payment methods tend to be more localized. But really, Wallet Connect Pay sits alongside all of those other payment methods. And that means that when we're talking to a payments company about enabling this, we've got to speak their language. They actually shouldn't need to understand how crypto works underneath the hood. We should just be able to deliver the benefits of this as a payment method to them and to their merchant. So we plug into their existing systems, we give them the reconciliation data that they need in the format that they need it. We handle all of the complexities of crypto, ultimately just give fiat out at the back end to the merchant or to the payments company. And this simplifies their journey in crypto completely. So really our goal here is to put it in language that they understand, which, as you said, is this is cheaper, it's faster, it gives you these additional benefits, it's global, and you can launch it really easily with Wallet Connect Pay.
And do you see a world where this evolves to, and I guess right now, give us a before and after, right? We've got fiat coming out when it hits the merchants, but when it comes to the consumers that are coming at the point of sale, are we expecting them to come with stable coins? Or do you think, we can bring fiat to the point of sale to, a regular consumer? It looks like they're just using fiat. Are we going to end up integrating stable coins in this middle part to improve settlement times, improve settlement costs? So it looks like, fiat in, fiat out, but we kind of move the money with stable coins in the middle. Do you think that's one of the end states that we ultimately get to?
I mean, I think the ultimate end state is like all pieces of the economy sit on chain. So people are paid in stable coins, and we're seeing that growing a lot today. So they're getting paid in stable coins. They want to pay for things with stable coins. And then those companies are paying their employees and buying from their suppliers and paying all their bills in stable coins. Ultimately, everything should sit on chain over the long run. Now, today, typically we see most people who want to pay for stuff with crypto or with stable coins already have those stable coins. People aren't going through the painful on-ramping process just to make a transaction. They typically already have that. So that number of people is growing. And I think actually, if you look at it the other way around, today many merchants want to take fiat out at the back end. They don't have the right setup to be able to accept these payments directly in stablecoin, but they are moving almost from a separate thought process. They're moving their on-chain or their treasury management on-chain anyway. And so you can kind of close the loop in a way, and eventually we may remove that fiat off-ramp kind of component, and the payment goes all the way end to end in stable coins. So I think really the long-term game should be that we don't need any of those traditional rails. Obviously that's a nice dream to have, and will be a long time away, but I do think that a very meaningful proportion of payments, B2B payments, consumer payments, salary payments, payouts, how people are managing treasury is going to shift on chain over the coming years.
There's a study done recently by I'm looking at it now, McKinsey and Artemis. So two data providers in this consulting firm that said, granted, the stablecoin industry right now is upwards of $380 billion. Most of that is currently in B2B transactions. That accounts for $226 billion. Remittances is $90 billion. Capital markets is $8 billion. True stablecoin payments represent just 0.02% of the global $2 quadrillion payments market. And so I think you guys are currently sitting at where the bulk of the stablecoin activity is happening in the B2B payments category. But as we look at payments as a whole, that whole category of payments, where, do you see the puck moving next in terms of how we're going to, because, we agree with you. We think 100% of the $2 quadrillion payments market will be on chain, but how do we get to 100%? Right now we're only at 0.02. Is it more growth in B2B? Do we ultimately get more remittances, or is it more retail? How do you think the stablecoin market at large starts to cannibalize and supersede more and more of the global payments market?
Look, I think all of these things are very symbiotic, and I think really you need all of the pieces in place to make it make sense. Does it make sense to receive all of your salary in stablecoin if you have to off-ramp it all? Yeah, maybe for some people, but probably not for many. Whereas once you can actually pay for everything, then it might make more sense. Similarly, if you're a business, does it make sense to move your treasury on chain if then you have to off-ramp again to pay your suppliers? Probably not. But if you combine the treasury and the supply chain payments together, might make more sense. So actually you need a lot of this stuff to come together to make it make sense for people. The other thing you need is the right incentives and for people to have the right motivations to do this. And that means giving them great user experience so that this isn't worse than what they have today. And I think until now, crypto payments are arguably a lot worse than a tap to pay card experience. So that's one of the things that we are really, really focused on, is making that user experience great. And then you need to think about who is incentivized to do what. And that's where some of the, and it's really experimental at this stage, but that's where some of the like cashback experiments that we're running, these kind of like rewards or like interchange type rewards that we're giving to our wallet partners and to other people as part of that flow, hopefully create enough incentives to make people change, because we all know that consumer behavior can be really sticky. And so we need the right motivations, merchants offering you a discount if you pay in crypto to kind of change that behavior, for example. Lots of things that we can do there to try and experiment with that. But that's definitely going to be one of the, I guess, challenges for crypto payments over the coming years, is how do you take what people are used to and make them use something different?
And to your point, incentives are a great way to do that. Could you give us a sense of the incentives that are out there now, and tell us, how are businesses and users able to take part in these incentives?
Yeah, so what we've just announced for like the launch of Wallet Connect Pay is that for the initial period, end users paying with Wallet Connect Pay in store or online will get 2% cash back. And then we've got some other cool promotions, I think, coming up with a few merchants who are going to offer additional discounts. We've got a few asset like stablecoin issuers, for example, who want to offer additional incentives for using their specific stablecoin. So I think we're going to see that incentive pool and the types of incentives that we can offer grow over the next little while. How do people get involved? I think if they want to become a direct merchant, then they should reach out to us. We have a few partners that we're doing that with. We're getting great feedback from them. It's a great learning experience. So if people really want to get started ASAP and their existing payment provider can't give them crypto payments, then they should get in touch with us. But I would encourage merchants to speak to their payments providers, tell them that they're interested. A lot of payments providers are interested in this, but they want to know that there's demand from their merchants. And so, have those conversations with your payments partners.
Yeah, I mean, this article about what's stopping you from receiving stablecoins is particularly interesting, as well as it pertains to the incentives here, because I think there's still just this big education gap, as well as just a convenience gap, right? So let's talk about what actually happens when someone goes through an Ingenico physical kind of like toast machine and taps to pay, right? You tap to pay, your credit cards come up, you just click one, Face ID, scan, done. Similarly, I assume how we want this flow to work for Wallet Connect Pay is either, as you guys have in a QR or a tap with a crypto card. When it comes to actually using the crypto that I have on a mobile app on my phone, how is that going to work from point of sale perspective, right? So what is going to stop me from being able to actually spend my stable coins that I have in a Wallet Connect app, in a MetaMask, in a Phantom, etc., or if I have like an EtherFi card or a Crypto.com card on my tap to pay, what's going to stop me from actually being able to do that in the real world as this actually rolls out? Is there a specific requirement from the user side that I need to have in order to be able to spend my stablecoins?
So I think there's a really important distinction between spending stable coins on a like stablecoin native or a crypto native payment kind of method versus what we see in the market today as stablecoin cards. If somebody's got a stablecoin card today, that's usually a Visa or a MasterCard. And what happens as part of that flow is that the moment that you tap your stablecoin card, those stablecoins leave the on-chain world. They go straight back into the old world, and the rest of the payment flow is completed on those old Visa or MasterCard rails. It means that the merchant doesn't get any of the benefits, doesn't get cheaper payments, doesn't get faster settlement time. They're basically just a Visa transaction or a MasterCard transaction that are pretty indistinguishable for the merchant from any other card transaction. So those stablecoin cards are great for end users because people want to pay with crypto, but they don't bring much benefit to the rest of the ecosystem. And they certainly don't keep assets on chain. Now, what we're trying to do with Wallet Connect Pay is keep those assets on chain for as long as possible, make sure that the end-to-end payment flow can take place on chain. That means that when you scan your QR code with your wallet, and you mentioned MetaMask, there are hundreds of others that this is compatible with. When you scan that QR code with your wallet, the money is actually moving on chain. It's not being off ramped at the point that you tap it. For some merchants, it's going to be off ramped, but eventually we can just take that piece out and people can be settled end to end on chain. For you as a user, looks like you scan the QR code and then you're asked to basically pay. It's a one-click experience. I think over time, we're hopeful that we can also translate that to NFC experiences. So it's much more of a tap rather than a QR code scan. Although in some parts of the world, the QR code is a very familiar form factor for payments, if you go to Southeast Asia or somewhere. But we want to make this feel as close to a like Web 2 payments experience as possible, so that everyone feels comfortable making those payments.
Yeah, I mean, I think that the QR code in the Western world is a bit less accepted than the tap. I think generally people want the easiest flow, and I'm not sure. Like basically, what you're getting at here is that you want to make it so that the stable coins stay on chain and the money stays in the on chain environment throughout the entire sales process into the end of the sale, rather than having to do the off ramp or on ramp process. And so would that then require the business that's accepting the stablecoins to also be willing to hold stablecoins in some sort of like wallet or account, or like if I'm a business and then I get paid in stablecoins through Wallet Connect Pay, I have to pay my employees, my property taxes, my rent. Aren't I just going to want to then off ramp that as well and pay that? Or is the idea then, I guess in the future to be able to also pay your expenses with that same stablecoins that you've just received?
Yeah, so today we absolutely enable merchants to receive fiat out at the back end. To your point, not all of them have wallets and not all equipped to do that. And so we manage the entire payment process on chain. And then at the last mile, we do a conversion to fiat to settle to those merchants. Now, obviously, the end state is that we don't need that. And as more and more merchants also have the treasury management piece and everything else set up, eventually we can just take that out and kind of join the dots at either end, so that the payments go in stable coins and go out to merchants in stable coins. We'll already see merchants, or some businesses anyway, wanting to pay their employees. So again, it's about us moving as much as much of this on chain as possible. And over time, I think we'll be able to remove some of those fiat components. But for now, it's really important that a merchant, if they want to, can take fiat.
What would you say is one of the biggest gaps or obstacles still today to completing this value chain on chain? Like what are some of the things that you know are still yet to be accomplished here that we're focused on going forward?
Look, I think there is a lot, not all of it within the Wallet Connect domain. We're really
course, yeah.
focused on those like payments experiences. But I think, for example, true like payroll for employees still has some work to do when it comes to things like taxes and reporting. A lot of like government tax forms just aren't equipped to understand when somebody's paid out in crypto. Works quite well for contractors, but less so for employees oftentimes. So some of that, I think a lot of existing like accounting tools, accounting setups, accounting methodologies, even in top parts of the world, need updating. It's very recently that we've got real clarity on like what is a stablecoin, what counts as a stablecoin in the US. That definition is still evolving in other parts of the world. So for a business to kind of truly be on chain and not even need a bank account so that they can pay all their suppliers, pay all their rent, pay their employees, etc., and then be able to accept all money in crypto, pay their taxes in crypto. We're quite a long way away from that.
Right.
But I think what we will see is these two worlds kind of slowly intertwining. Today maybe like 1% is taking place on chain. Maybe tomorrow that's 5%, and maybe in 10 years time that's more like 95%. But that fiat world and the existing setup that we have has to work hand in hand with the on-chain world. We see that more and more, and so it's important that these two things are seen as being able to work together.
Yeah, I see it very, very similarly to the way that we're thinking about legacy finance, where we believe that banks everywhere are going to be forced to innovate. They're going to be forced to pay higher yield eventually, whether it's a result of regulation or a result of them just getting innovated by some of these neo banks. And as a result, they're forced to sort of change and adapt their ways. Similarly to what you're saying, it seems like as an industry, the way to think a bit of this is, look, if we can front load a lot of stablecoin users in the front part of that value chain, these people, they want to pay at point of sale with stablecoins, it'll slowly start to force merchants and eventually the merchants at a higher level, like the municipalities, the tax collectors, the property taxes, all of these things, and the payroll as well, as you mentioned, will be forced to accept stablecoins and be more stablecoin centric if we front load the first half of that marketplace, because more people are using them. And so I'm curious if you're thinking about it the right that same way, and if so, what are some examples of jurisdictions that are doing a great job of this now? You mentioned Southeast Asia as a form factor, but where are some of the more stablecoin centric places in the world so that we can kind of use those as a shining example?
So I think we're seeing two types of jurisdictions almost where stablecoins are kind of growing very fast. One is actually where like the existing financial system is not doing so well and people want to they want to move into stablecoins sooner. So somewhere where people actually want to reduce their exposure to the local currency and want to hold their assets in a dollar-denominated currency, for example, there's a real pull there from the ecosystem to have stablecoins because that's what people really, really want. So we see that in Latin America and a few other countries around the world. On the other hand, we also see jurisdictions where actually at the government level, they're very pro stablecoins, pro crypto, and want to see this happen. The US obviously has made big moves there in recent years, but also the EU put out some announcements today, not crypto or even payment specific, but talking about like EU tech to move away from like the dependence on some big US companies. So I think there we will start to see, EU native payment rails, account to account payments or crypto payments start to be something that people become more interested in. Similarly, there are some other like very forward thinking places around the world where crypto really has to be like legal tender, like El Salvador and other places. So it comes both top down and bottom up, I think, in terms of different places around the world driving forward that adoption.
Yeah. I mean, last thing from my end, just with regards to the adoption side, and globally at Davos last week, Jeremy Allaire, the CEO of Circle, really had a big headline hit with regards to how he sees agentic payments happening with stablecoins over the next 5 years. Really just, this is going to be a massive use case for stablecoin payments. I think of like micro payments on the internet. I think of using, subscription-based payments, all these different types of stablecoin flows in an agentic sense. How are you building Wallet Connect Pay, and just generally, how are you thinking about your strategy as the agentic kind of payments flows start to trickle in over this year, next year. I imagine next year we probably see some agent to agent payments happening. How do you think about this from a business strategy perspective and from a product perspective?
Yeah, look, I mean, Wallet Connect has always been this like network that allows wallets to communicate with apps, and you can translate that pretty directly, which is that agents will probably have wallets that want to communicate with apps. And so I think a lot of this is very aligned with how we've always seen the world. It's just that instead of you and me controlling the wallet, it will be your agent that is controlling the wallet. Obviously, we need to make those messaging types compatible, but everything that we do is sort of in line with that, in line with things like the X402 standards and others. And really, we have a great history at Wallet Connect of creating standards that are open source. We write a lot of the chain agnostic standards. We've written several Ethereum improvement proposal standards, and we create a lot of our own standards for how our wallets and apps should interact with each other on an open source basis. And I think that there's some great work being done, and obviously lots more to do, but that it's really rooted in creating these standards that it's going to make it easy for people to build on these systems.
Yeah, makes a lot of sense. Jess, just give us some closing thoughts here and tell us where Wallet Connect is headed after this. You guys have this flagship partnership and are doing tremendous work. Any key milestones as far as direct merchants or how much volume you'd like to see going through Wallet Connect Pay throughout 2026?
Well, across the Wallet Connect network, so not payment specific, but across the Wallet Connect network, last year we had just over $400 billion of transactions taking place. So for the network, I would love for us to build on that this year, and we're ahead of plan, I think, although we're only at halfway through January. So I think we at the network level will continue to see that growth. For Wallet Connect Pay, it's very hard to know because this is still such a nascent industry. But I think if you look at people's willingness to pay with crypto, with these crypto cards, albeit those numbers have gone up significantly. And so that demonstrates to me that people want to be able to pay with crypto. I think we'll have our first merchants with the Ingenico partnership coming online, hopefully at the end of this month or early next month. So we'll start to see that. We've already got a few merchants direct with us live. There's a great coffee shop in Lisbon that people can go and use the new Wallet Connect Pay experience with. And of course, we've got all the existing partnerships that we have with other payments companies where you can use that more traditional Wallet Connect flow, but still execute a payments experience. So, for me, 2026 is about bringing more people a great payments experience and more merchants who want to accept crypto, whether that's with us or generally. I think that's the direction that we're all pushing towards so that we can keep more things on chain.
Yeah.
Feel a
Jess,
market brewing. $1 trillion.
Quadrillions. Thank you for your time. Congrats on the Wallet Connect Pay announcement. Looking forward to the moves in 2026. It's funny how we've came from payments being such a big part of the foundational infrastructure of blockchain back in 2017, 2018, when Robbie and I joined. Almost like forgot about it all as if it was too boring for the last 6 to 8 years. And then now we're back and it's like, okay, we're going to get back to the most important things that we can do, guys, on chain at scale. So Jess, again, thanks for coming on and congratulations.
Thanks so much for having me.
Guys, we'll take a quick break and we'll be right back and end off the show today. Thanks, Jess. See you guys in a sec.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your.
Alrighty, guys. That's the show for today, Monday, January 26th. Great. 3 guests. Big news. Silver has the biggest volume ever. Maximum volume. It's like taking over. It's a 5 Sigma event.
You know why I'm bullish on the catch-up trade is because remember, like the central bank thing, you know, you can say that gold's run up is dominated by central banks accumulating gold, failure of the US dollar reserve currency. But if that was the case, like we wouldn't see copper and palladium and silver and uranium. Those wouldn't be going up too. Like this is a general thing. And I do believe that like Bitcoin's got just as much sauce as copper. And
guys,
silver.
It's a big week. We need a strong close here from the crypto coins this week, or else guys,
Andy's gonna go back to surfing and streaming. And we wouldn't want that. Come join us. Enjoy the green candles with us, Andrew.
Guys, thank you for being here today. We'll see you tomorrow. Mahalo.